Earnings-related implied moves and implied volatility generally. Does it make sense to buy options going into earnings or to sell them? Obviously, it depends. Goldman Sachs came out with a few names they think one should be buying volatility on. We're going to talk about that today on Open Interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mic here on the Open Interest YouTube channel. One of my colleagues who has access to Goldman Sachs research shared their weekly options watch with me earlier this week, and in it they were talking about some of the names where they thought it made sense to buy straddles going into earnings. Now, unfortunately, I won't be able to share on my screen anything from that report. I don't know that much about copyright law, but I'm pretty sure they wouldn't appreciate it if I shared that with everybody in a public forum. But I think we can certainly talk about some of the names that they mentioned. Their buy, sell, hold recommendations just under Reg FD rules are generally speaking going to be public knowledge that's usually already out there due to Reg FD rules, so we can certainly talk about that. And I think we can talk about the examples that they were highlighting and talk about the way they are thinking about it, whether that's also the way that I think about it, and how maybe you might want to. So with that in mind, I created a little spreadsheet here, which I think I can share, and we'll just take a look at that very quickly. These are some of the names that are reporting earnings in the near future. I'm going to try to blow this up just a little bit so that those guys don't have to, and I think I can make this more full screen, so let's do that. And just take a quick peek and see whether you can get a good look at it. And just blow this up a little bit more, and maybe if I even make these all bold, how about that? There we go. So hopefully you guys can make this out. So in column F on this spreadsheet is the earnings-related implied move. And in column E is the expected report date. Let's talk a little bit about the earnings-related implied move. This is something that I hear people, I talk about it on CNBC when I'm on fairly often, and I hear other people talk about it. There is a little bit of a misconception. People who've watched this live stream before will know the distinction that I'm about to make. And it's not hugely important, but I'm going to mention it anyway because it's helpful sometimes to just be able to, back of the napkin, do a little bit of simple math to sort of figure out what's going on. First thing first, volatility, when we talk about it in an options context, simply refers to the standard deviation of the price movements of the underlying stock. That number is always expressed as an annual number. So even if I'm looking at 1 day, 1 week, 1 month, 1 quarter, 2 years even, we standardize everything to an annualized number. And the way you can adjust an annualized number to any other period is you divide that number by the square root. Now I realize it's going to seem a little complicated mathy. It isn't really, so just bear with me. You divide the implied volatility by the square root of the amount of time to expiration. So, for example, if you have a 1-month option, for example, and you have a 30% annualized implied volatility, you can divide that 30% implied volatility by the square root of 12. And that will give you essentially the monthly equivalent. So traders will still say, oh, I bought 30 vol. I bought 1 month 30 vol, 30%. But they're expressing it in annualized terms. So if you want to know how much that works out to, you need to take that 30% and divide it by the square root of 12. So when we talk about expected moves, which is what usually people mean when they're talking about earnings-related implied moves, they're saying, what's the expected move? What's the average move. What they're really referring to is something called the mean absolute deviation. And the mean absolute deviation is not the same thing as the standard deviation. It's just another statistical measure. So if you had a normal distribution, you can figure out what the standard deviation of that distribution is. And you can figure out what the mean absolute deviation is. The standard deviation is just, nearly 70% of the time, 68% of the time, you expect it to be within plus or minus 30% over the course of a year. And if it was going to be, over the course of 1 month, you divide that number by 3.46. So to get the mean absolute deviation, you just have to multiply that. And I'm not going to get into the math of all of this, but just multiply that by about 0.8 and you're going to get that number. When we look at the earnings-related implied move, we're talking about how much the options market is expecting the stock to move up or down on average. So what's the mean of all of the possible moves, basically based on the statistics that we have available to us, over 1 day. So I bring this up because the way Goldman Sachs does this work, and we're going to go through an example of this right now for Burlington stores. By the way, just so you know, as we take a look at this, the names that are highlighted in yellow, like Estee Lauder, Workday, and Okta, are names where, in Goldman's case, they were expecting, some caution is what they were basically saying. You should be cautious in these names going into the earnings print. Burlington was one of the names that they were positive on. Ignoring Goldman Sachs for a moment and just talking about what the street's views are, we can take a look at these numbers over here, these best analyst ratings numbers, which I'm highlighting. I'm just going to put some conditional color scales on this so we can sort of see the higher the number that is, the more bullish the street is, and the lower the number is, the more bearish the street is. Okay, makes some sense. This is a scale of 1 to 5, or actually it might be 0 to 5, I think 1 to 5. The important thing, though, of course, to remember in all of this is that we rarely see sell recommendations, right? So something that has 5s is all buys. We rarely see sells. So the reason I like to use color scales is because really what we're interested in is sort of the relative bullishness, not whether they actually are saying buy, sell, hold. Although we can see that at least one of these names right here, which is Hormel Foods, it seems like there are quite a few sells. So that's the most bearish name on this list. Okay, so let's work through Burlington, which is a name that they happen to like. And I believe that their perspective was that you should be buying calls going into the print. So let's just take a quick peek here. And we're just going to see what the street's perspective is. If you can see my screen, hopefully you can see that the street is pretty overwhelmingly bullish on this. A quick point I want to make is that that's always nice that the sell side happens to like a name. But I will also say that if you have a stock that has just been doing extremely well, everybody loves it, there is always the risk that you have a little bit of a crowded trade there. In the same way that if a stock just has been performing very, very badly, everybody hates it, there's a high short interest, that you have another form of a crowded trade. And sometimes it makes sense to try to make the contrarian case in those instances. But all right, be that as it may. So we can see here that the street is indeed generally very positive on it. So let's talk a little bit now about this implied move, and is it high or is it low kind of thing. So in Burlington's case, by Bloomberg's work at least, hopefully you can see my cursor here. This is the earnings related implied move by their work. So this is a 1-day implied move by their work for earnings, which they're going to be reporting on August 23rd. 2.6%. That is versus a longer term average of 7.5%. So let's just talk about how far back we want to go when we're taking a look at average moves and things like that. So just very quickly, I don't think it makes a whole lot of sense to go way back in time. That's the first thing I would say. The reason for this is that you can have meaningful structural changes in the balance sheet of a business. I think an example of this that I had been using recently was with, it may have been with Carnival Cruise Lines actually, and that is that the company had taken on a lot of debt during the pandemic. Makes a lot of sense. You know, their revenues went to zero. It's expensive to maintain ships and all the rest of it. They ended up having a lot more leverage on the balance sheet. The more leverage you have on the balance sheet, the more volatile the equity of that company is going to be, all else equal. So I think it makes sense to do two things. First, you want to see whether over the course of recent history at least, there has been any meaningful change in the amount of leverage on a company's balance sheet. So let's do that first. So this is just a high-level financial overview that Bloomberg can provide, but you can get this directly from the investor relations website for any business, but it's just easier for me to, rather than go find that, to just go through here. So what we can see here, just focus only on these top few lines, if you will, for just a few moments. And actually what I should probably do is just, we're going to look at this on a quarterly basis because I'm really interested in quarterly earnings moves. So we're just going to go and take a look at how this has changed over the course of the last 8 quarters or so. So this is 5 quarters. I'm going to go back 3 more, 3. All right, and as we can see, the total debt level for the business and their net cash hasn't really changed very much over the course of the last 8 reported quarters. So we don't need to think too much about whether the equity has become more or less levered. It is somewhat less levered. Why do I say that? Well, let's just go back again. I'm going to go all the way back here. So if we go back to 2023 Q2, you have or Q3 here, $9 billion equity market capitalization versus $4.7 billion in debt, less $400 million. So we'll call it $4.3 billion in net debt. Now, the company has appreciated, so we are at a higher equity, market capitalization. So that's just the value of all of the equity. $16 billion now, with $4.1 billion in debt. Okay, so as we think about that on a relative basis, debt to equity has declined. So an important thing to think about there as we think about how much something like this could potentially move on earnings. Okay, so what we're going to do now is we're actually just going to take a look at how much it moved the day that they reported the last 8 quarters, and then we're going to take a look at a different type of window. So the way, we can look 1 week after, 1 month after, and also the way I like to think about it too is how much time do I have before earnings, how much time do I have after earnings going to whatever expiration I happen to be looking at. Okay, so just very quickly, as it happens, I can just export this to Excel, so that's what we're going to do. You can probably find ways to do this yourself as well. Just go back to prior reported periods and take a look. So I'm just going to take a look at the earnings move the last 8 quarters, and that turns out to be 11.4%. So the company has moved, the stock has moved 11.4% on average over the last 8 reported quarters. So now, with that information in hand, we can actually take a look and say, well, how much do the options on this thing cost? So they report on the 23rd, so we can actually look at the straddle for the 23rd. I'm going to look at the 255 straddle. So we're just going to pick a nice number right here in the middle. I'm just going to say $6, $7, $13. Okay? So that means that the mean absolute deviation as implied by options prices between now and the 23rd of August when these options expire is about $13. That is obviously a lot less than the 11.4% that the company has moved on average just the day that they've announced earnings, let alone 9 days in and around earnings. So as we look at that, it suggests that those options are indeed cheap. Quick problem though. The 23rd is, and this is going to be, some of you have seen me talk about this before. Notice anything funny about the 23rd? It's a Friday. Companies don't usually report on Fridays. So that immediately gives me a little bit of hesitation. So I'm suspecting that there's something wrong with that expected report date, this 23rd report date. Another way we can confirm that is by taking a look at the term structure. So the term structure basically maps out, and again, these are all in annualized, and I'm going to get rid of this old one here. So this is the term structure of options. So this is the implied volatility for options of different expirations. So this is the ones that expire tomorrow, 40 vol. The ones that expire on the 23rd, round numbers again, 40 vol. The ones that expire on the 30th, 61 vol. What does that tell us? There's a good chance. We haven't even gone to the investor relations website yet. All we've done is just taken a look at the price of options. The price of options are telling me they don't report earnings next week. So that's the first thing, right? So now we are going to do basically what I said I wasn't going to do before, which is drag you through investor relations, but we're going to do that. And we're going to see what they have to say. They will have announced when their earnings are, I'm pretty sure. Let's see, news and events. So they are going to have, oh, have they not even announced when that is? That would be very strange, but it's possible. So the options market, so this is the important thing. The options market is implying that this event is actually going to take place in a manner that you are going to be able to capture it in those 30th options. So don't bet on the 23rd. Now, normally, I would expect to see a press release announcing when this was straight away, but I don't see that. Okay, so Burlington, likely to report on the 23rd as Bloomberg and probably some others are reporting. My guess is no, the options market is telling us they aren't. So now we actually have to take a look and say, all right, well, are those options indeed still cheap relative to the implied move that we've actually seen? So that straddle, so, whoops, I'm on Deere, sorry. That's because that's what we were talking about on Monday. Oh, by the way, just a quick, glad, something came up. With those low inflation numbers suggest that the Fed has more room to cut rates. If rates come down, that does two things. It can be potentially inflationary, and it also is likely to lower financing rates. So those were two potential drivers for Deere that we talked about on Monday that, pull that into your calculus, if you will. The low inflation numbers are positive for Deere. You have to look out a little bit in time because you have to see those rate cuts. That's going to lower financing costs, and if it contributes in any way to inflation and commodity prices in a way that's helpful for farmers, that's the big drivers we were talking about. So just something to think about. It was something I was thinking about this morning, just for what it's worth. Okay, so 255. Now we're going to look out to the August 30th 255 straddle. So that one, now we'll just use $15. Nice. We'll pick a number in the middle. 15, 12. Why not? So $27. So now we're starting to get more into the realm of the kind of moves that we have seen in the past. Remember, that was 11.4% last 8 reported quarters. But that was the one-day move. So we actually have to make an adjustment now. So we're kind of honing in on things now, right? So I don't know exactly when earnings are, but I'm pretty sure they're after the 23rd and before the 30th. Options prices are basically telling me that. So that's where I'm going to focus my time and attention. Let's assume, for the sake of argument, that the expectation is that they were going to report on, this being a leap year, that they were going to report on Thursday. That would be the 29th of August. So what that would suggest is we have 16 days until August 30th expiration. Again, you're going to have to bear with me here as we just work through this a little bit. So I'm going to take a look at the historical move from 8 days prior to earnings to 1 day following. Okay, because that's approximately where I think we are right now. 8 days prior to 1 day following. So conveniently, Bloomberg terminals make this kind of work very easy, but it's not that difficult. All you have to do is figure out when the past earnings took place, and you can check the price from, say, 8 calendar days prior to 1 day following. So now that's what I'm doing here. I'm going to export this once again, and we're going to see what that earnings-related move was over that time horizon. So what we're really trying to do is we're just cross-checking other people's work and just ensuring that we're looking at the right time frame, the right earnings move, and then we're going to compare it to the straddles that are of approximately the same tenor. So I can't visually, yeah, I've got 8 in there. Okay. So what is that number now? The average move for that period is almost, you probably can't make it out, but just trust me, because these are really small numbers, 16.2%. That's the average over the last 8 reported quarters. Well, you would usually expect options premiums to have even a little bit sort of a buffer against those historical moves if the street was expecting anything similar. So what Goldman was recommending, and what one of our open interest colleagues was also in favor of, was using call options to subscribe to the bullish view. So remember, street is generally very bullish. I pointed out that when everybody's really bullish, that's great. We have a lot of people who are looking at this from different perspectives, and all of them see things that they like about it. It's all very nice, but we always want to sort of try to examine the opposite possibilities. So we're going to just take a quick view now at the stock technically, and we can see that we're well above the 150-day. That's what this chart is. So I'm just going to highlight this real quick so you can see that's that's the 150-day moving average. We're well above that. Historically, when we've gotten well above it, sometimes it has fallen back. We obviously have a catalyst potentially for that. So what calls would one use? Well, you obviously have to capture the event. So at a minimum, that's going to be the August 30th expiration calls to make a bullish bet. And actually, I don't remember which ones Goldman had suggested. Let me see. Don't share my screen while I do this, because if I'm going to pull this up, I don't think I'm allowed to show that. So, but I can tell you nevertheless. I think that's probably fine. See if I can find it. I will take a look here. The 260s. Okay. Yeah, somebody just got in my ear and told me, which is really helpful. Okay, so let's just take a quick peek at those. I'm going to pull up OptionPlay. And so I hope this has been a little bit helpful, just how you want to think about whether options are reasonably priced or not. Obviously, every earnings is a little bit different. But when you hear people saying, are options reasonably priced going into an event? Are they not? The things that I like to look at is take a look at the options prices. How much of a move are they implying? So that's the mean absolute deviation between now and some future date can be established by pricing out the straddle. This is the back of the napkin way. There's a more mathy way to take a look at event variance at discrete moments of time where there's a lot of time in between, but we don't really need to worry about that because we're just looking at upcoming earnings. So now we're just going to take a quick peek here and look at these calls. And by the way, oops, yep. What expiration were those calls, by the way? I'm sorry, yeah, those were the, so I'm just going to take, we know what strike they were, so we're going to look in here. I'm just going to go out to September regular way for this, yep, so we're actually, why don't we just go to that? Yeah, we'll do that. So 11.75, right? So $11.75, you are looking at, whatever, about 4% of the current price of the stock. It's got to go up a few bucks even to get to the strike. So call it a 5-6% move to the upside to get to your break even. That's just one way to do it, one way to think about it. And I hope that helps. Okay. So, having walked through that one trade idea, and there are several others, I want to get to some questions. So Bob asks, with the CEO moving focuses over to Starbucks, little attention is now to Chipotle. What is the future of Chipotle? Double down on Chipotle, December 50 long calls yesterday on the dip. Wondering, buy, hold, sell. Thanks. Okay, so a couple things about this. Yeah, Nicole going over to Starbucks, I mean, this was overdue. I think everybody who watches this live stream knows I talked about Starbucks after their really disappointing results. This is way in advance of McDonald's, talking about how pricing pressures were impacting their sales sort of across the board, but Starbucks absolutely bumping into that pressure. They had declining foot traffic. Every single thing they were reporting was pretty negative. Worse than that was the messaging from management on the earnings call when they did so, and I thought it was just miserable. In some ways, I'm surprised it took this long for Starbucks to have a meaningful management change. I don't know. I've never had any personal interaction with the outgoing CEO of Starbucks. I know that he spent a number of months working with Howard Schultz ahead of time in terms of getting prepared for that role. But the messaging was miserable. To talk about new offerings and the menu and flavored teas and things like that as a response to a real secular headwind, which was pricing. And actually their big secular headwinds were pricing was one, pricing and value. And the other thing that I'd certainly heard a lot of people commenting about, interesting because this is kind of an issue for Chipotle too, was basically time. How long it actually took. You'd go in and you'd order a coffee and you're standing around waiting. A lot of the drive-ins had prolonged wait times, and that was considered to be problematic. Now, I bring all of this up because Chipotle had they were having a little bit of a consumer pushback, and it became sort of a social media trend that people didn't feel like they were getting great value. So, they would talk about how little food they were getting at Chipotle for the money that they were spending. Now, I bring this up because the way Chipotle has since resolved that issue, apparently. But I've actually gone to a Chipotle a couple of times and focused on this issue specifically. Not because I'm a huge lover of Chipotle. I think it's fine. My kids happen to like it. But it was a big issue for a while, whether or not you were getting an appropriate amount of value. So on 2 occasions, I've gone in and I have ordered a bowl, which is basically, rather than getting a burrito, you can just have them give you all the stuff. What they do now is they actually layer the bottom of that with a ton of rice. And they do the same things with the burritos. I was watching them do this. And I think the observers of that, when you get done, you end up with a burrito that can't be closed. You end up with a bowl that's totally full. So it seems like they have improved that concern that consumers had about whether they were getting value. So We talk about inflation, that's just the rising prices, pushing consumers away. We talk about shrinkflation, which is more common in consumer products like those that you might find at the grocery store. You go and you buy a package of bacon, it was always a pound, now it's 12 ounces. You would buy coffee by the pound, then it was 12 ounces, then it was 10 ounces, and so on. So that's called shrinkflation. Chipotle was able to push back on some consumer concerns about the value proposition, but I think it's a form of shrinkflation when you start filling somebody's bowl or you start filling somebody's burrito with rice or beans, which are considerably less expensive than guacamole, barbacoa, or whatever. Now, I will say that for those that were ordering guacamole or sour cream or whatever, they seem to be throwing a ton of it on there, and that stuff's not cheap, so take that how you will. How is this relevant to Starbucks? Well, the problem here is that it's a little bit more difficult. You can't fill the bottom of a coffee cup with rice. So, and I'm not even saying that rice is cheaper than coffee itself. To deal with the value pushback that consumers have for Starbucks, as we've seen savings go down, as we have seen credit card balances go up, as we've seen auto loan delinquencies rise, not so easy. Will Nicole be able to solve that? We'll see. But it's interesting because in some ways he's dealing with a similar business. I think they did really well, by the way, to select him because there are two businesses that have had related kinds of pushback, things like that. So actually, let's just pull up Starbucks real quick. I'm going to do, yeah, I know that. Someone's getting in my ear and saying you're asking about CMG. So I'm going to get to that. But I wanted to mention this in the context of Starbucks first. Starbucks valuation, by the way, and I am going to get back to Chipotle, so we will get to that. So Starbucks valuation had gotten a lot cheaper. Clearly, as we look at forward numbers, it's simply because everyone's sort of forecasting declining top line, declining bottom line, and so on. So I think they did well to get Nicole in the top seat. And by the way, the top seat at Starbucks is always a little bit questionable because you kind of serve at the behest and the whim of Howard Schultz, in my view. Chipotle, on the other hand, so those who are watchers of the live stream will know that I did a live stream on Chipotle a while back, and I wrote an article about it as well, and I was not overwhelmingly positive on it. And I'm trying to remember exactly when that was. I believe it was early June, so I think it topped out in here a little after I had sort of made a bearish call on it. Here's my problem with Chipotle, and that is that the company just wasn't cheap, right? It was priced for enormous growth, and we have to wonder whether that growth could continue unabated in the face of a lot of these consumer pressures. And these consumer pressures, we saw it from Starbucks, and we saw it more recently from McDonald's. We saw it from restaurant supplier Lamb Weston. So this is not a knock on Chipotle, which I think does a wonderful job with their business. It is just a knock on the business generally. And pressured consumers are making shifts in their consumption habits. They're slow to do that. So that's the bad news. The good news is that everybody's got to eat. And I think I've also recited what the CEO of the franchise owner that owns the Applebee's in Times Square said on Fast Money a few months ago, which is that what typically will start to happen is not that people don't eat out, they still do. And if you're a single person, you're suddenly going to start cooking at home? Probably not. But they do make some shifts in what they purchase. So they will, switch from steak to chicken. Those kinds of shifts are taking place. The other thing is that inflation affected a lot of grocery prices too, right? So what you need to see is the commodity prices fall, the grocery prices fall, or level off at least, and for the spread between casual dining or fast casual, or I guess fast food. Chipotle is kind of like an upper end fast food place, I guess. You need to see that widen before the consumers are really going to start moving more to the grocery situation. So here, my thinking on Chipotle is basically this. You need, in the face of these consumer shifts, to actually see a real shift in. This has become a very technical trade, in my view. So if you're looking at my screen, I'm just going to take a look at the best performing technical indicators for Chipotle of late. And we can see it's kind of a mixed bag here. So there are, the best performing technical indicators are still leaning bearish at this time. And now I'm just going to compare this. Ignore buy and hold, please, because that's obviously not a technical indicator. That's just an investment strategy. So what you're really interested in right here when you're looking at what I'm showing on my screen, can I blow this up? Let me see if I can. I want you guys to be able to see this a little bit better. Can I go that big? There we go. Okay. So what are you looking at? I might even be able to go a little bigger still. Let me see. See if I can. So what are you, I just want you guys to know what you're looking at here, because it looks like the matrix, I'm sure, just a big waterfall of numbers. What I want you to pay attention to here is this column that I'm highlighting with my cursor right now. Can you see the little green hand? So everywhere there's an upward arrow, these are the technical indicators that are bullish right here and now. And everywhere there is a downward facing arrow, those are the ones that are bearish here and now. If the arrow is green, that means that the strategy is in the green since it made its most recent recommendation. And, well, unsurprisingly, you can see that most of the bullish indicators are red because the stock's been doing terribly of late. And so most bullish indicators are probably, especially those that are relatively short-term in nature, will have maybe caught a falling knife or bought the top, whatever. Only one of those is actually positive. And unsurprisingly, all of these bearish indicators are up money because the stock hasn't been performing well. When I'm sorting over here, as I'm going to do right now, what I'm doing is I'm actually sorting now by those technical indicators that have done well over the course of the last 52 weeks. So when I take the best performing one, triangular moving average, is bearish, up about 25%, because these all have a basis assumption of 100 million. And actually we can take a look at this and say, okay, where did it get bearish and why? So this is the triangular moving average. It got bullish down here. It got bearish when it violated that moving average over here. And so that's where we're at right now. I would really like to see sort of a more convincing recovery in Chipotle first. And the reason I want to see that is because, as I pointed out, it's still trading 40 plus times forward earnings. Good top line growth and all that, but it's not like they're growing EPS at 40% annually. And we also, we're trying to guess whether or not the street's forecasts are optimistic or not, in the same way that we were trying to do that for Deere earlier this week. And so it's not that I don't think the company is well managed. I think it's very well managed. It's not that it's not growing. It has been. It's demonstrated that. People have certainly gotten singed betting against it in the past. But, personally, I would prefer to look for a more convincing sort of reversal off the bottom than we've gotten so far. And my thinking about this is that if you're really playing for the kinds of moves that Chipotle has seen historically, you're not looking for the 5 to 10% off the bottom when we don't know where that is. I'd much rather miss that 5, 10% and catch the next 25 to 35% to the upside than to try to call it early. So that's kind of my 2 cents on that one. Remember this S, for those who haven't been watching, that just means the short sale rule is in effect. So that's the sort of the uptick rule for would-be short sellers. Anybody who is sort of more interested in that, you can go back and find the live stream we did with Jim Seligman, whose business is to deal with stocks that are in that situation. Okay. All right, let's move on. Mike Morrow says, okay, I'm going to pull that up. Let's have a peek here. Whoops, what were you looking at? Oh, that was just a thanks. Okay, I guess. Or were you actually looking at? I'm not familiar with that, so we'll. Looks okay. You were having some sort of a problem, I guess. Hello from somebody without a name. So Nameless asks, hello, Mike. May I know your opinion for UNG to hold long-term till February of 2025? Okay, so that's a product I have traded in the past, sometimes in pretty good size, it should be said. UNG, for those who don't know, is the ETF for the U.S. natural gas fund. And I'm curious, you didn't indicate why, but I'm a little curious, I have to say, why February is your target. So a couple things to think about when we are looking at exchange-traded products that are funds, essentially, that are trading futures. Now, actually, in the case of the U.S. Natural Gas Fund, it was true at one time that all they did was trade the Henry Hub natural gas future. It was the NYMEX future. And I was involved in the trade when this began to change. So back when John Arnold, formerly of Enron, was shorting the hell out of natural gas. And basically, he was just making a very big sort of macro nat gas play, which was that the Permian, we were just, we had gone from a period where we were always an excess producer of natural gas, so much so that in many cases it was a product that they would flare. You would encounter pockets of natural gas as you drilled for oil, and we had a lot of excess natural gas. We then went to a period of time where we actually were not producing quite as much as we consumed. And so natural gas prices went up. Europe, for example, does not produce as much natural gas, so they import it from places like Russia and so on via pipelines. And then we, of course, had the fracking boom. John Arnold recognized what this really meant, just how much more gas we were producing. And, it was, and interestingly, if anybody knows who Aubrey McClendon is, or was, Aubrey McClendon was the founder of Chesapeake, and he was, very successful, had at first, and was a victim of his own success. He developed natural gas production tremendously. He was based in Oklahoma, and ultimately, the fracking boom made it so that we had a glut of natural gas. John Arnold bet against that. The U.S. Natural Gas Fund, UNG, only traded the WTI Henry Hub contract at that time. And what ended up happening was, as everybody started shorting this thing, they started shorting UNG. He started shorting UNG and actually doing it via, our bank, among others. And what ended up happening was that the U.S. Natural Gas Fund actually hit the position limits for the New York Mercantile Exchange, and they couldn't create more of the ETF, and that created a big maelstrom. Became hard to borrow. It was a big mess. But the byproduct of it is that they don't just trade the futures anymore. And I mentioned that ahead of time because trading the futures is something that is easier to view the impact than it is in the case of UNG. But the important thing is that whether you're trading swaps, which they do now, so they trade a variety of futures, swaps, and so on natural gas to create the ETF. What happens is that the fund actually incurs a roll cost because they have to constantly move the derivatives that they have out in time. And because it is designed, it's not like you can do that, set and forget, so that you could buy futures or swaps years out. It is designed, this product is designed to track short-dated natural gas prices, which is actually what most people are interested in, because natural gas, unlike something like gold, it matters a lot when you are talking about the underlying asset. Why is that? I mean, gold is gold. It doesn't rust. It does, you store it. It's gold today is the same as gold tomorrow, same as 100 years from now. But natural gas is not like that at all, because natural gas has to be piped, it has to be stored, it has to, be extracted, all the rest of it. And that means that natural gas in October of this year can be a very different thing than natural gas in April of next year, of 2025. So we are in what is known in the natural gas world as the injection season. That is the period of time during which we are producing more natural gas than we consume. Excess natural gas is put into storage, like depleted salt mines or whatever. And at the tail end of the injection season, as winter approaches, the capacity in these storage facilities is essentially goes to zero. So you inject all that you can, and what can end up happening is, so this is known as the first of what are 2 shoulder months. So as injection runs out, you can't store anymore. You can get to a point where natural gas prices, if we're producing a ton of it and there's no storage and we're not burning it, it becomes essentially a worthless commodity. You're better off flaring it. You have nothing else that you can do with it. So when people are trading UNG, you're kind of trying to trade that wave. So what you're doing if you buy UNG right now is you're buying it going into the tail end of the injection season. The withdrawal season actually is usually beyond February. So the natural gas storage supply will generally begin to exhaust itself at the very end of winter. And if you have a prolonged and colder winter, then that can be a circumstance where you suddenly get a big spike in the price of natural gas at the tail end of that period. And by the way, for anybody who's saying, well, what do you know about this? I used to have a seat on the New York Mercantile Exchange, and I traded natural gas options. So this is just a very basic kind of high-level conversation. So you're dealing with two things when you buy UNG, the ETF right now. You're dealing with that dynamic, which is you're trying to own it going into the, during the injection season, but you're not going to have, if you own it into February, you're not going to have the possibility of that, that withdrawal shortage. And that's when you get those big spikes. We've seen them once or twice. In fact, actually, if you think back about the failure of the big hedge fund Amaranth and their natural gas trader, who was Brian Hunter, this was his big trade, was that he would trade this dynamic in natural gas. And he got this very, very wrong, because he didn't, I don't think, recognize, as John Arnold did, the dynamic that our excess production of natural gas was having on the natural gas market particularly at the tail end of the withdrawal season. And so he had made a common trade is to get into a calendar spread just in the futures, where you're basically making a bet on a short-term shortage for natural gas and this big spike, and you just trade one future against the other. But these costs end up essentially being a constant drag on something like UNG. And so if you have some unique insight where you believe that natural gas prices should spike at or go up sharply at an unusual period of time, which is the tail end of the injection season, that's fine to use it as a trading vehicle. But as a longer-term investment, I don't like it. I don't like it, and actually, let's just take a look at UNG over the long term. We're going to see this. I mean, that is the effect. If you're looking at my chart right now, you are looking at the effect of roll costs over time. And so I'm curious what the catalyst would be. And also one other thing too, which is that UNG is the U.S. natural gas fund. So there's a very big difference between what's going on in natural gas prices in Europe, for example, versus here. When they blew up that pipeline, and that was highly disruptive to European natural gas markets, it didn't have any impact on the U.S. natural gas markets, right? So maybe it helped if you were interested in Cheniere, right? If you were interested in companies that were specifically related to potentially exporting natural gas. But that's a de minimis part of the U.S. market. So if I was going to try to make a play for something bullish to happen in natural gas, I'd probably just focus on the futures where I think the catalyst is. So maybe you've identified a catalyst that I haven't. My 2 cents. I'm not a big fan of UNG buy hold strategies because you're just really fighting. You're really fighting the trend. It's a problem. Okay, Ulta Beauty exploding higher in after hours after Warren Buffett discloses a new position of 690,000 shares. With respect to Ulta, not as much now, but this is a Holly Index name for what it's worth. If memory serves, Brad Holt, you can refresh my memory on this too, perhaps, but there was an Ulta in BK's, Texas, which was not, it was a little out from where we lived in the Westlake area outside of Austin when we lived there. And there was an Ulta store there, and this was on Holly's, it was one of the places that she would shop. So it was a Holly Index name. Technically, well, let's have a look here. What do we got? Do we have a reason technically to buy this thing? That's really it does not appear, yeah, so, it's a good business. What are we looking at? Valuation, top line, barely growing, 10% forecast, reasonable valuation. But okay, so I don't mind it on a fundamental valuation basis if you're playing this thing for a turnaround. It's definitely, you can see right here if you're looking at this, this is as cheap as the company has been relative to its own valuation over the course of the last 2 years and probably the last 5. Yeah, so it's definitely on the cheaper end from a fundamentals point of view. My reticence, which you probably can detect, simply comes from the fact that, I would like to see some evidence of a turnaround first, right? This is you're kind of catching the falling knife right here, and it doesn't. Yeah, I'd like to see a positive reversal. Don't really have much else to offer other than that. I like the company other than that. Apologize. I always like it if I can say, yeah, that's a great trade. I love it. What the hell do I know? But yeah, it's a little early. Buffett, obviously, if he's planning on buying a lot more of it, that's the other thing, right? So if he's been buying it on the recent declines we've had, how much more of it is he going to acquire? I mean, I guess that's an okay reason, but don't forget he's got a holding period of theoretically forever. We know from his recent Apple sales that that's not true, is it? But that's how they talk about their views, and of course there's a good reason for that. He doesn't have any interest in paying any kind of taxes on these things, but for what it's worth. Okay. So, Easy Mike says, comfy Chipotle job. Yeah, so, that's a good point. It's a good point. A lot of people had hoped that Starbucks' growth story was going to come from China, and Lukin, kind of eating their lunch there. Kind of interesting, actually. It seems, and this doesn't just apply to Starbucks, but a lot of Chinese companies are getting traction in their own market. People are not just buying it for some foreign prestige factor. So that applies to cars as well as it does to other consumer products. Yeah. So interesting Nike news. I don't know whether if you have a specific trade idea or something that you're trying to evaluate in the case of Nike, this was another situation where I'm really looking for, this looks like an interesting target. We could probably look at these pandemic lows. It has certainly bounced off of these recent lows, and we have a big unfilled gap here, which is potentially very interesting. And this was not a growth story. The company, people always used to assign a big premium to this, and now it's trading at a pretty good discount, I believe, to the market overall. Actually, let's see here. What do we got? We had been 30 times, and now what do we have? So I'd like to see one of two things, which is a little bit more confirmation technically. And when is our next earnings here? This is coming up, actually, isn't it? September 27th. I'm going to table that one. I want to do a little bit of work on this one, and we have some time to do that. So they report on the 27th, and so I discussed Chipotle on the June 3rd live stream. Just got that from one of the producers. Yeah, that's. I remembered it was probably a little bit before it hit its all-time highs. And Michael Anthony was saying, you bought CMG. No, I was bearish on Chipotle at that time. Yeah, so somebody's pointing out, you might be asking the other viewer, Bob, but yeah, I was bearish on Chipotle back in June. I didn't know it was going to roll over quite this hard, and of course I didn't realize that that Starbucks was going to hire their CEO. I certainly recognized that Starbucks needed a new one. I didn't know they were going to take Chipotle's, but there we are. Michael Anthony, right? Yeah, and look, here's the thing about this Nike rebound too, right? It's modest on a relative basis, and the catalyst we have to look forward to is earnings. We've got some things on the horizon. I think it deserves a little bit more work. Michael Anthony said that UNG did a reverse split, which was bad. So it's always going to be doing reverse splits because of the decay. So it's always decaying over time. And so all of these ETFs have to do continuous reverse splits to accommodate that, or they'd be trading for pennies. Back when I did that huge UNG trade, that was back in the John Arnold timeframe. I still remember the prices for UNG. It was about $15.60 a share, and I was trading the October 14 puts about 4 months prior, so it was sort of midsummer, looking out to October. Somebody wanted to buy the position limit in October 14 puts, and I was one of the people who was selling some of those and helping to syndicate the trade. It turned out that that buyer was John Arnold. So I was on the opposite side of John Arnold. A very sort of a painful exercise for me. We traded 250,000 of those October 14 puts at the time. And let's just take a quick peek at when that was. Okay, so I was still at Cantor Fitzgerald when I did that trade. And that was more than 10 years ago. So to put things in perspective, this gives you a sense of just how many reverse splits have taken place. Oops, I've gone back too far here. But let's just go back to January. I think this would have, I believe it was 2011 that I did that trade, I believe. Was it 2011 or 2010? My memory is imperfect. Okay, so 1474, it was 1560 at the time I did that trade, midsummer, which I think was 2010, now that I think about it. So pre-split, or reverse split in this case, that was 1,000. It was trading 1,000 at that time. But actually, at the time, it was trading $15.60 a share. So that's what we've seen in terms of these reverse splits. That's what happens to these things. It's going to happen to this. It's going to happen to anything where you have this constant roll cost. It's going to happen to anything where you're trying to buy volatility over time. So VIX-related products that are just buying VIX futures, they have these roll costs. And over time, that doesn't work. Now, does that mean that they are a good short? Well, over time, they are a good short, bearing in mind that the reversals, when they occur, can be incredibly sharp and painful, particularly in the VIX-related products. But that's what we have there. So what time is it? I was just checking. I'm going to quickly scan the question list here to see what we have. Tucker D. Dog notes, Nike pops on Pershing news. Topic from today, in the same filing that they announced that their Chipotle holdings were cut by 23%. Yeah, I mean, actually the most interesting thing coming out of Pershing as far as I'm concerned is the fact that they were going to do a $20 billion sort of closed raise, and that whole thing just imploded. I wonder sometimes whether that might be because he's decided, that is to say Bill Ackman has waded into the political fray a little bit. That's a dangerous thing to do. I don't know if that's had any implications on his money-raising efforts, his fundraising efforts for that fund, but one wonders. One wonders. Okay, so I have squandered fully an hour plus of your time, but you guys are immensely patient for sticking around, and I appreciate it. And I really appreciate the comments and the questions. So on the agenda for our next live stream will be Nike. I'll have to take a look at that. And what else are we going to be taking a look at? Let's see what else is, just very quickly. And you know what? Put this into the comment or chat. If you guys have something that's going to be reporting earnings that you're interested in taking a look at, Nike I think is an obvious one. And we have some time. And FedEx. My nemesis, FedEx. My God, has that thing just killed me on earnings so many times. I mean, and in other ways too. Just, I hate trading the thing. But it's an important one to look at because we care a lot about how the logistics business and transportation is doing. You know, as they often will say that transports are indicative of how the economy is doing more broadly. As in terms of their operations and the product that they offer, I like FedEx quite a lot, but in terms of the business, it's been much more of a struggle for me. I'll admit that. But those are at least two that I think we should focus on Monday ahead of their earnings. And if you guys have any other suggestions, please put them into the chat. We'll try to take a look at them. Thanks very much for watching.